Hi guys, it's CT Johnson, the funding doctor here. Today is 113 of the pandemic, and this is the funding doctor's COVID-19 survival financial guide. Today I want to talk about something that I spend a lot of time talking to my clients about, which is the difference between non-bank lenders and the banks. A lot of people have misunderstandings about how non-bank lenders work, and so I wanted to clear a few things up by telling you about the top 5 ways non-bank lenders differ from the banks. The first is lower LVRs. Private lenders, non-bank lenders will always give a lower loan-to-value ratio than the banks will. The reason for this is that they have smaller portfolios and therefore they just can't take the kind of risk on a single project that the banks can do. The large banks particularly have huge portfolios and they're able to take greater risks, and so they will offer LVRs that are typically 80%, sometimes 90%, or even 95% on some types of loans. With a non-bank lender, rule of thumb is 65%. Frequently, it can be as low as 50, sometimes it's as high as 70 or maybe even 75, but rule of thumb is 65%. So if you're looking for a higher LVR, loan to value ratio, you need to stick with the banks and not with the private lenders. Number 4, higher cost. The private guys are always going to have higher interest rates than the banks. And again, the reason for this is very simple. The banks are getting their funding mostly from the Reserve Bank of Australia and from depositors like you and me who put our money in, and we're getting a quarter a point a month or something ridiculous like that. So essentially the money is almost free to the banks. So they can turn around and lend it out at 3%, 4%, 5%, something like that, and still make a very good return. Private lenders, on the other hand, mostly get their money from high net worth individuals and especially funds, mostly like retirement funds. So those sources of funds demand a higher return. Usually they're demanding between 6 and 8%, which means that the non-bank lender has to charge something higher than 6 or 8%. Sometimes you get things that are a little bit different than that, but that's kind of a rule of thumb, is that the non-bank lenders, the private guys, will almost always be higher than the banks in terms of their interest rate, which begs the question, if they are giving you lower LVRs and higher interest rate, then why do you use them? Number 3, because they're more involved in the project. Now, this is kind of a plus minus thing, but they tend to be closer to the project, and especially if you're new or if you're not that experienced, they have a lot of expertise that they can bring to the project to help you with that. For instance, if you get into a problem with your builder, frequently they will have relationships with the builder and they'll be able to help you with that or help move things along. So they are more involved. Number 2, they are less restrictive. They're much less restrictive than the banks. The way the bank works is they start with an interest rate and then they build around that what their requirements are. So in order to qualify for a 5% loan, you have to be pretty clean. And they set out a list of requirements, a list of boxes for you to tick. And as long as you tick all those boxes, you can have the loan at 5%. And if you don't tick all of those boxes, then you don't get the loan at all. It's not that the banks will adjust the rate, you just don't get the loan at all. The privates work in a different way. They say, what is the situation that you have? What boxes can you tick? And based on that, they give you a rate. So if you are, very risky, or if your project is very risky, then they will build in a higher return, and you have at least the choice. You can take this loan and pay the higher interest rate, or you cannot do it. The banks don't give you that choice. So that's one of the biggest reasons why people go to non-banks as opposed to banks, is that they're much, much less restrictive. And then the number one reason why people go to non-banks instead of banks, the number one way in which they're different from the banks is that they are way faster. It's very common that I will get an answer, at least a preliminary indication from a non-bank lender on whether they want to do a deal and what the terms are, more or less, on that deal. Very common that I get it within 24 hours. Very common. With a bank, very uncommon that you would get it. Sometimes it's a week or 2 weeks or a month before you even get that. Time to settle, with a private, it can be 6 weeks or maybe 8 weeks. It'd be a pretty common deal for, say, a construction loan. For a bank, not uncommon for that to take 6 months. I've had a number of different clients who they came to me because they were so frustrated because they said, it's just one more thing. Every day it's a new thing with the bank. And there's another reason why it's not going to be this week, it's going to be next week. And this has been going on for months and I can't do it anymore. The non-banks are very good at moving quickly. So that's kind of the way that the non-bank lending works. If you're coming to a non-bank lender because you want a better rate than what you think you can get at the bank, you're barking up the wrong tree. If you are coming because you think you can get a better loan to value ratio, again, that's the wrong place to look. If you want to move fast and if you want to have more flexibility in what you're doing, the non-banks are the right place to go. And that's what they have to offer. So that's a little bit about how the non-bank works compared to the banks. My name is C.T. Johnson and I'm the Funding Doctor. Take care. Bye.